The information provided in this presentation is for educational and informational purposes only, and is not intended to be a substitute for professional financial advice. You should consult with a qualified financial advisor, mortgage broker, or other professional to determine what may be best for your individual needs. We are not financial advisors, and the content of this video should not be considered as financial advice. Any action you take upon the information on this video is strictly at your own risk. Imagine two people, let's call them Jessica and Mike. They're both software engineers in Austin, Texas. They both make $120,000 a year. They've both diligently saved up a $60,000 down payment. After months of searching, they both find the exact same model of home, in the same new development for the same price, $500,000. They go to the same lender on the same day to apply for a mortgage. On paper, they are identical candidates. But that's where the story takes a sharp turn. Jessica gets a call back from the loan officer. She's approved. Her interest rate is 6.5%. Her monthly payment will be about $2,780. She's ecstatic. She's on her way to becoming a homeowner. Mike gets a call too. The news isn't as good. He's also approved, but his interest rate is 7.75%. His monthly payment, $3,150. That's $370 more every single month. Over the life of his 30-year loan, Mike will pay over $133,000 more than Jessica for the exact same house. $133,000. That's a brand new Porsche. It's a college education for his future kids. It's a life-changing amount of money, vanished into thin air because of one single solitary factor: his credit score. Jessica's score was a 765. Mike's was a 670. Both are considered good or fair by most consumer websites. But in the cold, hard world of mortgage lending, that 95-point difference is a canyon. It's the difference between an easy approval with a great rate and a stressful, expensive process that puts your dream just a little further out of reach. This isn't just a story about Jessica and Mike. This is the hidden reality for millions of Americans trying to buy a home right now. You might be one of them. You're doing everything right. You're saving your money, you've got a stable job, you're paying your bills on time. But there's this 3-digit number, this ghost in the machine, that holds an incredible, almost terrifying amount of power over your financial future. And the worst part? Most people have no idea how it actually works. They don't understand what the banks are truly looking for. They see their score on a free app and think, okay, 680, that's pretty good. Without realizing that in a lender's eyes, that 680 might as well be a flashing yellow warning light. The entire system feels like a black box, a secret language spoken only by underwriters and loan officers, designed to be confusing. You're told to just get a good score. But nobody tells you what good actually means to the person signing off on a $500,000 loan for you. Nobody explains why a 739 might get you a good rate, but a 741 unlocks a whole new tier of savings, potentially tens of thousands of dollars. Nobody tells you that the score you see on Credit Karma isn't even the same score the mortgage lender pulls. That's right. The score you're so carefully tracking is likely not the one that will decide your fate. Well, that ends today. Right here in this video, we are going to take a sledgehammer to that black box. We are going to demystify this entire process from top to bottom. This isn't going to be vague, generic advice like, pay your bills on time. You already know that. This is a masterclass in understanding the FICO scores that mortgage lenders use and how to position yourself to get the absolute best deal possible. By the time you finish this presentation, you will know exactly what a mortgage lender sees when they pull your credit report. You will understand the different credit score tiers, the magic numbers that separate the high-risk applicants from the VIPs. You'll learn why a single late payment from 3 years ago could be costing you a fortune, and what you can do about it. You'll discover the hidden tripwires that can cause your score to drop just weeks before you apply, torpedoing your application at the last second. And most importantly, you will learn the actionable strategies, the specific steps you can take starting today, to clean up your report, boost your score, and walk into that lender's office with the confidence of someone who knows they deserve the best rate. Because this isn't about just getting approved for a mortgage. Anyone can get approved for a bad deal. This is about saving you $50, $80, even $100,000 or more over the life of your loan. It's about not letting a number you don't fully understand dictate the next 30 years of your life. The dream of homeownership in America is a cornerstone of building wealth, of creating a stable future for your family. But that dream can quickly become a financial nightmare if you overpay because of a credit score that could have been improved. The banks and the credit bureaus benefit from your confusion. The more you don't know, the more they can charge you an interest. It's that simple. Knowledge is your armor in this process. And today we are going to arm you to the teeth. We're going to translate their secret language into plain English. We're going to pull back the curtain and show you exactly how the game is played so you can play it to win. So if you're even thinking about buying a home in the next 2 years, you cannot afford to miss this. What we're about to cover is the single most important financial education you can get before you start looking at houses. It's the foundation upon which your entire home buying journey will be built. Get this part right and everything else becomes easier and cheaper. Get it wrong, and you're starting the race with your shoelaces tied together. So where do we begin? Before we can even talk about the specific scores you need for a conventional loan, an FHA loan, or a VA loan, we have to go deeper. We have to understand the DNA of your credit score. What is it actually made of? It's not just one thing. It's a recipe with 5 key ingredients. And the mortgage industry weighs those ingredients differently than, say, a credit card company. Understanding this recipe, understanding these 5 core pillars, is the first and most critical step to taking control. Because if you don't know what builds the score, you have no chance of rebuilding it in your favor. Let's break down the 5 components that every lender in the United States scrutinizes, starting with the undisputed king of them all, your payment history. This single factor accounts for a massive 35% of your entire FICO score. Think about that. More than a third of your creditworthiness boils down to one simple question. Do you pay your bills on time? To a mortgage lender, your payment history isn't just a record. It's a prophecy. It's the single best predictor of your future behavior. If you've been consistently late on a $200 credit card bill, why on earth would they trust you with a $3,000 monthly mortgage payment for the next 30 years? Imagine you have a friend who is always, and I mean always, late. The first time you let it slide. The second time you're annoyed. By the 5th time you just stop inviting them to things that are time sensitive. You've lost trust in their reliability. Lenders operate on the exact same principle, but instead of social invitations, they're withholding hundreds of thousands of dollars. A single late payment, just one, can drop a great credit score by over 100 points. And it stays on your credit report for 7 years. It's a bright red flag waving frantically at the underwriting department. The severity matters too. A payment that's 30 days late is bad. One that's 60 days late is significantly worse, because it shows it wasn't just a one-time oversight. It was a sustained problem. And a 90-day late payment? That's a catastrophic event in the credit world. It signals a major financial struggle and can be an almost automatic denial for a prime mortgage. Lenders see that and think, this person was unable or unwilling to pay for 3 straight months. The risk is too high. Every single account matters, from your car loan to that old department store card you forgot you had. On-time payments are the foundation upon which your entire mortgage application is built. A shaky foundation means the whole structure is at risk of collapse. Now let's move to the second pillar, which is almost as important, weighing in at 30% of your score. This is amounts owed. But that name is dangerously misleading. It's not about the raw dollar amount you owe. A person with a $50,000 student loan can have a better score than someone with a $2,000 credit card balance. What the algorithm truly cares about is your credit utilization ratio. This is the secret sauce. It's the percentage of your available revolving credit that you are currently using. Let's say you have one credit card with a $10,000 limit, and you have a balance of $5,000 on it. Your credit utilization is 50%. To a lender, that looks risky. It suggests you're living close to your means and might not have a buffer for emergencies. Think of it like driving a car. If you are constantly redlining the engine at 90% of its maximum RPM, you're putting immense stress on the machinery. It's a sign that something could break. Lenders see high credit utilization the same way, as a sign of financial stress. The general rule of thumb you always hear is to keep your utilization below 30%. That's decent advice for beginners. But if you want to get a mortgage with the best possible interest rate, you need to play in the big leagues. The pros, the people with 800+ credit scores, keep their utilization below 10%. Yes, single digits. This shows lenders that you have access to credit, but you don't need to use it. It demonstrates discipline, control, and a massive financial cushion. The biggest mistake people make here is right before applying for a mortgage. They might max out a card to buy new furniture for the house they don't even own yet, or consolidate other debts onto one card. In doing so, they'll see their credit score plummet by 50 or 60 points right when they need it to be at its peak. When your underwriter pulls your credit report and sees your utilization has spiked from 15% to 85%, the loan application comes to a screeching halt. They don't see new furniture. They see a new unacceptable level of risk. Coming in at number 3 with 15% of your score is the length of your credit history. Time is your ally in the credit game. Lenders want to see a long-established track record of responsible borrowing. A credit history that's 15 years old is far more reassuring than one that's only 2 years old. It provides a much larger data set for them to analyze your long-term habits. This component is calculated in 2 ways: the age of your oldest account and the average age of all your accounts combined. This is why one of the most common and damaging pieces of financial advice is to close old credit cards you don't use anymore. It feels like you're being tidy and simplifying your finances. But what you're actually doing is taking a metaphorical saw to the oldest branch on your credit tree. Let's say your oldest account is a credit card you opened in college 10 years ago. You also have 2 other cards you opened 2 years ago. The average age of your accounts is a little over 4.5 years. Now, you decide to close that old college card. Suddenly, your oldest account is only 2 years old, and your average account age drops to just 2 years. Your credit score will take a direct hit. You've just artificially aged yourself down in the eyes of the lender. You went from looking like a seasoned, reliable borrower to someone who is relatively new to the game. When you're asking for a 30-year loan, demonstrating a long, stable history is paramount. So keep those old, no annual fee cards open. Put a small, recurring charge on them like a streaming service and set up autopay. Let them sit there and quietly add years of positive history to your report. It's one of the easiest ways to protect your score. Next, we have 2 components that are a little smaller, but can still make or break an application on the margins. Each accounts for 10% of your score. The first is your credit mix. Lenders like to see that you can successfully manage different types of credit. Think of it like a balanced diet. Surviving on just one food group isn't healthy. Similarly, having only one type of credit isn't a sign of robust financial health. There are 2 main categories of credit: revolving credit, like credit cards and lines of credit, where you can borrow and repay repeatedly, and installment loans like mortgages, auto loans, and student loans, where you borrow a fixed amount and pay it back in equal installments over a set period. An ideal credit report shows a healthy mix of both. It proves you can handle the responsibility of a monthly car payment just as well as you can handle the temptations of a credit card. If you've only ever had credit cards, a mortgage lender might be a little hesitant. They have no evidence you can handle a large, long-term, fixed payment. But if they see you've been successfully paying down a 5-year car loan, it gives them confidence that you understand how installment debt works. It de-risks you as a borrower and makes them more comfortable handing you the keys to your new home. Finally, also at 10% is new credit. This factor looks at how recently and how frequently you've applied for new credit. Every time you formally apply for a loan or a credit card, it triggers what's called a hard inquiry on your report. 1 or 2 hard inquiries over a couple of years is no big deal. But a flurry of them in a short period of time is a major red flag. To a lender, this behavior screams one of 2 things, and both are bad. Either you're in financial trouble and are desperately seeking a lifeline, or you're about to take on a lot of new debt that they can't yet see on your report. Imagine applying for 5 different store credit cards in a month to get discounts on your shopping. Each of those applications hits your credit report. When the mortgage underwriter sees this, they don't know if you were approved for all 5 cards and are about to go on a $10,000 spending spree. That uncertainty is pure risk. This is why it's critical to go into a credit lockdown for at least 6 to 12 months before you apply for a mortgage. No new car loans. No new credit cards. No financing a new phone. Don't even apply to refinance your student loans. You want your credit report to be as stable and boring as possible. You need to present yourself as a safe, predictable, and reliable bet. Opening a bunch of new accounts right before asking for the biggest loan of your life is like showing up for a job interview and telling them you're also interviewing with all their top competitors. It undermines their confidence in your commitment and stability. So there you have it. Payment history at 35%, amounts owed at 30%, length of history at 15%, and then credit mix and new credit each at 10%. Together, these 5 pillars form the complete picture that a lender sees. They tell a story about your past, which lenders use to write the story of your future. Understanding how to master each of these components is the difference between getting a rejection letter and getting a set of keys. But knowing what they are is only half the battle. Now we need to talk about where to find your score, how to read your report, and what the different score ranges actually mean for your wallet. So where do you even begin this treasure hunt for the 3-digit number that holds so much power? The first mistake most people make is looking in the wrong place. You might log into your banking app or a free service like Credit Karma and see a number staring back at you. You see a 740 and you think, great, I'm golden. But then you walk into a mortgage lender's office and they pull a number that looks more like a 690. The panic sets in. What happened? You've just fallen victim to the biggest misunderstanding in the credit world: the difference between a Vantage score and a FICO score. Most of the free services you use provide a Vantage score. It's a perfectly legitimate credit score, and it's a fantastic tool for monitoring the general health of your credit. It's like taking your temperature to see if you're sick. But when you go to the doctor for major surgery, and getting a mortgage is major financial surgery, they don't just take your temperature. They run a whole panel of specific in-depth tests. That's the FICO score. Over 90% of top lenders in the United States use FICO scores to make their lending decisions. And it gets even more specific. They don't just use any FICO score. For mortgages, they use older, more trusted models. Typically, it's FICO Score 2 from Experian, FICO Score 4 from TransUnion, and FICO Score 5 from Equifax. These are the industry standard dinosaurs of the credit world, and they are notoriously tougher and less forgiving than the newer, more consumer-friendly scores you see online. So, where do you find these specific mortgage-centric scores? The most direct way is to go straight to the source, myfico.com. Yes, it costs money, but think of it as the price of the blueprint to your future home. It's a small investment to avoid a massive 6-figure mistake. Some credit card companies like Discover, Citi, and American Express also offer a free FICO score to their cardholders, which can be a great starting point. But here's the critical piece of the puzzle. Lenders don't just pull one score. They pull all three, one from each of the major credit bureaus: Experian, Equifax, and TransUnion. Then, they typically throw out the highest score, throw out the lowest score, and use the one in the middle. This is your mortgage score. If your scores are 710, 725, and 740, your lender is going to base their entire decision on that 725. This is why you absolutely must know your numbers from all three bureaus. Flying blind with just one score is like trying to navigate a maze with one eye closed. Now, that 3-digit score is just the headline. The real story, the juicy drama, the details that can make or break your application, are all found in your full credit report. The score is the grade. The report is the report card that shows how you got there. You are legally entitled to a free credit report from each of the three bureaus once a year through annualcreditreport.com. This is the official government-mandated site. When you open that report, it can look like a wall of confusing text and codes, but it's actually a story in 4 parts. Part 1 is your personal information. This seems boring, but it's the foundation. It lists your name, address, social security number, and past employers. You need to read this section like a detective hunting for a clue. Is every address one you've actually lived at? Is your name spelled correctly? A simple typo or a mixed-up address could link your file to someone else's, potentially merging their bad credit with your good name. I've seen cases where a John Smith Jr. had his application torpedoed because his report was mixed with his father's, John Smith Sr., who had a bankruptcy. Check this section with a fine-tooth comb. Part 2 is the heart of the report: your credit accounts or trade lines. This is a detailed history of every credit card, car loan, student loan, and past mortgage you've ever had. For each account, you'll see when it was opened, your credit limit, the current balance, and most importantly, your payment history. This history is often shown as a grid of little boxes or symbols, indicating whether you paid on time, 30 days late, 60 days late, or worse. A single 30-day late payment can drop your score by 60 to 100 points, and it stays on your report for 7 years. This is the section lenders scrutinize the most. They're looking for a long history of responsible on-time payments. They want to see that you don't max out your credit cards. A high credit utilization ratio is a massive red flag. This section tells them if you're a reliable borrower or a risky bet. Part 3 is credit inquiries. This is where you see a list of every company that has officially requested to see your credit report. It's crucial to understand the difference between a soft inquiry and a hard inquiry. A soft inquiry, like when you check your own credit or a company sends you a pre-approved offer, has zero impact on your score. You can check your own credit 100 times a day, and it won't hurt you. A hard inquiry, however, happens when you actively apply for new credit, a credit card, a car loan, or a mortgage. One or two of these won't do much damage, but a flurry of them in a short time can make you look desperate for cash, which lowers your score. But here's a massive pro tip that busts a common myth. The scoring models are smart. They know that when you're shopping for a mortgage or a car loan, you're going to apply with multiple lenders to find the best rate. So, all mortgage-related hard inquiries made within a 14 to 45-day window are bundled together and treated as one single inquiry. So please shop around for the best mortgage rate. It won't destroy your credit score. Finally, Part 4 is public records and collections. This is the section you hope is empty. It's where the most damaging financial events are listed. Bankruptcies, foreclosures, tax liens, and accounts that have been sent to a collection agency. Having an entry here is like having a giant, flashing neon sign that says, high risk. A bankruptcy can stay on your report for up to 10 years, and a collection account for 7. These are the score killers, the application deniers. If you have anything in this section, it needs to be your absolute top priority to address. So, you've found your real FICO scores, you've decoded your credit report, and now you have a number. What does it actually mean? Let's put this into real dollars and cents. Imagine you're applying for a standard 30-year fixed-rate mortgage on a $400,000 home. If your score is in the excellent range, let's say 760 or above, you're what we'll call top-tier Tom. Lenders roll out the red carpet for you. They're competing for your business. You'll be offered the absolute best interest rates available. Let's say you lock in a rate of 6%. Your monthly principal and interest payment would be about $2,398. Over 30 years, you'll pay around $463,000 in total interest. Now let's look at good enough Gina. With a score between 700 and 759, she's still in great shape and will get approved without much hassle. But her interest rate won't be the best. It might be 6.5%. That half a percentage point doesn't sound like much, right? Wrong. Her monthly payment is now $2,528, which is $130 more every single month. Over the life of the loan, she'll pay over $510,000 in interest. That's nearly $50,000 more than Tom, just because her score was in the good tier instead of excellent. $50,000. That's a luxury car, a college fund, the trip of a lifetime. That's the real cost of a few dozen credit score points. But what if your score is in the fair range between 620 and 699? Meet Fringe Frank. This is the gray area. Frank might get approved, but it's going to be expensive. His interest rate could jump to 7.5% or even higher. His monthly payment is now $2,797. That's $400 more per month than top-tier Tom. And here's the kicker. With a score in this range, he will almost certainly be required to pay private mortgage insurance, or PMI, which is extra insurance that protects the lender in case he defaults. That could add another few $100s to his monthly payment. Over 30 years, Frank will pay a staggering $607,000 in interest, almost $150,000 more than Tom for the exact same house. And finally, if your score is below 620, you're rejected, Rachel. For most conventional mortgage programs, a sub-620 score is an automatic denial. The door is closed. While some government-backed loans like FHA might be an option with a lower score, the terms will be punishingly expensive, and the process will be a grueling uphill battle. Seeing these numbers in black and white is sobering. The difference between a good score and a great score isn't just bragging rights. It's the difference between financial struggle and financial freedom. It dictates not just if you can buy a house, but how much house you can afford and how much wealth you can build over your lifetime. So you've pulled your report, you've seen the number, and maybe your heart just sank a little. You're looking at Fringe Frank's numbers and thinking, that's me. You might feel stuck, but I'm here to tell you that your credit score is not a permanent tattoo. It's a living, breathing number you can change. And in the next part, we're going to turn you into a credit score surgeon, giving you the exact tools and secret techniques to perform precision strikes on your report that can boost your score faster than you ever thought possible. Alright, scrub in. Your patient is on the table, and their vital signs are your credit score. This isn't just a number. It's the living, breathing financial heartbeat that lenders will scrutinize under a microscope. And you are the lead surgeon. Your mission is to stabilize this patient, boost their vitals, and get them strong enough for the marathon of a mortgage application. Throw out everything you think you know about quick credit fixes. We're not using band-aids. We're using scalpels. We're performing precision surgery based on the exact formula the scoring models use. Let's start with the heart of the entire system, the single most important vital sign: your payment history. This accounts for a massive 35% of your FICO score. Think of it as the patient's EKG. A steady rhythm of on-time payments is a sign of a healthy, reliable heart. One single late payment, however, is a cardiac event. It flatlines your score's momentum and stays on your chart for 7 long years. The first rule of this operating room is simple: never, ever miss a payment. Automate everything. Set up autopay for at least the minimum amount on every single account. Your phone bill, your credit cards, your car loan, everything. You can always pay more later, but that automated minimum payment is your life support machine. It prevents a catastrophic error caused by simple forgetfulness. But what if the damage is already done? What if you have a 30-day or 60-day late payment staring back at you on your report? This is where most people give up. But a surgeon doesn't give up. A surgeon uses a specialized tool. In this case, it's called a goodwill letter. This is one of the most powerful, under-the-radar techniques you can use. You're not disputing the late payment. You're admitting it was a mistake and asking for a compassionate removal. You write a polite, professional letter to the original creditor, not the credit bureaus. In it, you take responsibility. You explain the circumstances. Perhaps it was a medical emergency, a job loss, or a simple, honest oversight. Most importantly, you highlight your otherwise stellar payment history with them. You're saying, "Look at my chart. This was an anomaly. I've been a loyal and responsible customer for years. Please consider removing this one-time negative mark as a gesture of goodwill." It doesn't always work, but you would be absolutely shocked how often it does, especially if you've been a good customer since the incident. A single goodwill deletion can add 20, 30, even 50 points back to your score. It's a delicate procedure, but one worth attempting. Next, let's look at the patient's breathing. The amount of debt you owe, or what the industry calls your credit utilization ratio. This is the second most critical vital sign, making up 30% of your score. It's a measure of how much of your available credit you're using. If you have a credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. High utilization makes you look like you're gasping for air financially. Lenders see it as a sign of risk, that you're overextended and living on the edge. The golden rule is to keep your overall utilization below 30%. But if you want a top-tier score, the real secret is to keep it under 10%. The difference between a 35% utilization and a 9% utilization can be staggering. So how do we perform surgery here? The obvious answer is to pay down your balances. That's the primary treatment. But there are 2 other precision techniques. First, you can request a credit limit increase on your existing cards. If your limit goes from $10,000 to $20,000, that $5,000 balance suddenly drops your utilization from a dangerous 50% to a much healthier 25%, without you paying a single extra dollar. Most card issuers let you request an increase right through their app or website with a soft pull, which won't hurt your score. Do this every 6 to 12 months. The second technique is a short-term, high-impact maneuver for right before you apply for your mortgage. It's sometimes called the ASIO method. All 0 except 1. You pay off the balances on all of your credit cards to 0, except for 1. On that one card, you leave a very small balance, something like $10. This shows the scoring models that you are actively using credit, but are in complete control. It's a powerful way to maximize your points in this category right when it matters most. Now let's talk about the patient's age and experience, which is your length of credit history. This is 15% of your score. It's a measure of how long you've been successfully managing credit. A longer history is like a seasoned veteran. It shows stability and predictability. There's no quick fix for aging your accounts, but the surgery here is preventative. The biggest mistake people make is closing their oldest credit card account. You might think, "I never use this card, I'll just close it." Don't do it. That's like removing a healthy, mature organ. That old account is the anchor of your credit age. Closing it can dramatically shorten your average account age and send your score tumbling. So keep it open. Use it once every 6 months for a small purchase like a pack of gum, and pay it off immediately. This keeps the account active and reporting, preserving that valuable history. Want a secret technique to give your credit age a transfusion? If you have a trusted family member like a parent with a long-standing credit card in good health, meaning a high limit, low balance, and perfect payment history, ask them to add you as an authorized user. You don't even need to have or use the physical card. The entire history of that account, all those years of on-time payments and that high credit limit, can be grafted onto your credit report. This can instantly add years to your average account age and lower your overall utilization, providing a significant boost, especially for someone with a thin or young credit file. Finally, we have the last two components, each accounting for 10% of your score: new credit and credit mix. Think of these as specialist consultations. They're important, but they follow the big three. Credit mix is about showing you can handle different types of debt responsibly. Lenders like to see a healthy mix of revolving credit, like credit cards, and installment loans like a car loan or a student loan. If all you have are credit cards, getting a small installment loan like a credit builder loan from a credit union, and paying it off can show diversity and potentially add a few points. New credit is all about how you shop for debt. Every time you formally apply for a loan or credit card, it results in a hard inquiry on your report, which can temporarily dip your score by a few points. One or two isn't a big deal, but a flurry of them in a short period makes you look desperate for cash, like a patient showing up to multiple emergency rooms at once. It's a major red flag for mortgage lenders. So the surgical rule is this: in the 6 months to a year leading up to your mortgage application, enter a credit lockdown. No new car loans, no new credit cards, no financing a new sofa. Protect your score. When you are shopping for a mortgage, the scoring models are smart. They know you're rate shopping. All mortgage-related inquiries within a 45-day window are typically treated as a single event, minimizing the damage. So keep your mortgage shopping focused and efficient. These aren't just tips. This is the blueprint. Payment history is the heart. Utilization is the lungs. Credit age is the wisdom and experience. By performing these precise surgical procedures, sending goodwill letters, managing utilization below 10%, preserving old accounts, and timing new applications, you are taking direct, methodical control of your financial health. You are transforming from a worried patient into a confident, skilled surgeon, preparing your file for the most important financial operation of your life. And now that you know how to heal your score, the next step is to learn how to spot and remove the cancers, the errors and inaccuracies on your report that could be silently killing your chances of approval. Think of your credit report not as a document, but as your financial DNA. It's a detailed history of your promises, both kept and broken. And just like in biology, sometimes mutations happen. Errors, inaccuracies. These aren't just typos. They are malignant cells that can grow undetected, metastasizing into a full-blown mortgage denial right when you're at the finish line. Let me tell you about a client we'll call David. David was the perfect applicant on paper. A 6-figure income, a long and stable job history, and a hefty 20% down payment saved up for his dream home in a quiet suburban cul-de-sac. He'd been pre-approved with flying colors. He found the house, made an offer, and it was accepted. For weeks, he and his wife were picking out paint colors and measuring for new furniture. Then, 2 weeks before closing, he got the call from his loan officer. A call that made his blood run cold. His final application was denied. His credit score, which had been a solid 760 just a month prior, had inexplicably crashed to 610. Total panic. How was this possible? He hadn't missed any payments. He hadn't opened new lines of credit. He hadn't done anything differently. The lender, bound by law, sent him an adverse action notice, which included the credit score they used and the reason for the denial: a recent and severe delinquency. David immediately pulled his full credit reports from all 3 major bureaus: Equifax, Experian, and TransUnion. And there it was on his Experian report: a glaring radioactive error. An auto loan, which he had paid off and closed in good standing 2 years ago, was suddenly being reported as 120 days delinquent and sent to collections. It was a ghost from his financial past, reanimated by a data entry error, and it was actively haunting his future. That single mistake, that one cancerous cell, cost him over 150 points and was about to cost him his family's dream home. David's story isn't a rare one. The Federal Trade Commission has conducted studies showing that 1 in 5 consumers have a verified error on at least one of their credit reports. 1 in 5. Look to your left, look to your right. Statistically, one of you is walking around with a ticking time bomb in your financial profile. So, how do you perform the surgery required to remove it? First, you need to get your hands on the patient's chart. And I'm not talking about those free score apps you see advertised everywhere. Those are great for monitoring, but they don't give you the full, detailed report you need for this kind of deep dive analysis. You need the official documents. By federal law, you are entitled to one free, full credit report from each of the three major bureaus, Equifax, Experian, and TransUnion, every single year. The only place to get them is annualcreditreport.com. That is the official government-mandated website. Don't get tricked by sound-alike sites. Go there, verify your identity, and download all three reports. Why all three? Because they don't always talk to each other. A creditor might only report to one or two of the bureaus. An error like David's might only appear on one report, but that's all it takes for a lender to pull that specific report and deny your application. You need a complete, 360-degree view of your financial self. Once you have the reports, print them out. Get a highlighter and a red pen. You are now a forensic accountant, and this is your crime scene. You are going to go through every single line item with a magnifying glass. Start with the easy stuff, personal information. Is your name spelled correctly? Are all of your past and present addresses accurate? Is your social security number correct? A simple mix-up, like a transposed digit in a previous address, can sometimes link you to someone else's debt. A terrifying situation known as a mixed file. Next, move to the main event, your credit accounts. For every single account listed, credit cards, auto loans, student loans, past mortgages, you need to verify 5 key things. 1. Do you recognize the account? If you see a card from a store you've never been to, that's a massive red flag for identity theft. 2. Are the details correct? Check the account number, the date it was opened, the credit limit, and the current balance. 3. Is the payment history accurate? This is the most critical part. One incorrectly reported late payment can drop your score by dozens of points. If the report says you were 30 days late in May, but you have a bank statement proving you paid on time, highlight it. That's your evidence. 4. Is the account status correct? An account you paid off and closed should say closed or paid in full. It should not, like in David's case, be listed as open and delinquent. 5. Are there any duplicates? Sometimes a single debt can be listed twice, making it look like you owe double what you actually do. After you've audited your accounts, look at the public records section. Are there any bankruptcies, liens, or judgments that don't belong to you? And finally, skim the inquiries section. A hard inquiry happens when you apply for credit. If you see inquiries from companies you've never contacted, that could be another sign of identity theft. Once your audit is complete, you'll have a list of every inaccuracy. Now it's time to fight back. This is where you leverage the Fair Credit Reporting Act, or FCRA. This powerful federal law gives you the right to an accurate credit report, and it lays out the exact process for correcting errors. Your weapon in this fight is the dispute letter. You can file disputes online through the Bureau's websites, and for simple errors that can be fast and effective. But for something as critical as a mortgage application, I recommend the old-school, ironclad method. A formal dispute letter sent via certified mail with a return receipt requested. This creates a legal paper trail that cannot be ignored. In your letter, you must clearly and concisely state 3 things. Your personal information, which specific item on your report you are disputing, and why you believe it is an error. Don't write an emotional novel. Be factual. I am disputing account number 12345 from XYZ Bank. This account was paid in full and closed on January 15, 2022. It is being inaccurately reported as 120 days delinquent. Please remove this inaccurate information from my file. Along with your letter, you must include 2 things. A copy of your government-issued ID, like a driver's license, and a copy of a utility bill or bank statement to prove your address. Most importantly, include copies, never the originals, of any evidence you have that proves your claim. For David, this was the paid-in-full letter from his original auto lender and the bank statement showing the final payment. You will send a separate, customized dispute package to each bureau that is reporting the error. You should also send a similar letter to the original creditor that reported the false information. You attack the problem at both the source and the publisher. Once the credit bureau receives your dispute, the clock starts ticking. By law, they have 30 days to investigate your claim. They will contact the creditor that furnished the information and ask them to verify it. If the creditor cannot prove the information is accurate, or if they simply don't respond within the 30-day window, the bureau must delete the item from your report. Period. It's the law. For David, it was the most stressful 30 days of his life. He was in constant contact with his loan officer, who thankfully was able to get an extension on their home contract. On day 28, he got an email. Experian had completed its investigation. The original auto lender could not verify the delinquency they had reported. The negative trade line was deleted. The next day, David's credit score shot back up to 765. He resubmitted his application, got an instant approval, and closed on his house the following week. He won. He removed the cancer. This process is your right. It's your power. An inaccurate credit report isn't just a nuisance. It's a false accusation against your character and your reliability. It's a lie that can cost you tens of thousands of dollars in higher interest rates or worse, deny you the key to your own front door. Taking the time to meticulously clean your credit report before you even speak to a lender is not just a suggestion. It's one of the most powerful and proactive steps you can take in the entire home buying journey. It transforms you from a passive applicant hoping for the best into the active CEO of your own financial life. And with a pristine, accurate report in hand, you're now ready to wield it like a finely crafted tool. You're ready to approach lenders not with hope, but with confidence, prepared to secure the best possible loan for your situation. So let's talk about the moment of truth. The point where all your preparation, all your meticulous report checking, meets the cold, hard reality of a lender's underwriting software. You walk in with confidence, but what the lender sees first isn't your handshake or your well-organized folder of documents. They see a number, a 3-digit score that, in a fraction of a second, tells them a story about your entire financial past. And based on that number, they place you into a specific category, a tier that will define the entire trajectory of your mortgage journey. Think of it like a video game with different difficulty levels. Your credit score determines which level you get to play on. The first, highest tier is what we'll call the elite. These are the people with scores of 800 and above. In the mortgage world, an 800 plus FICO score is the equivalent of a platinum key. It doesn't just open doors. It makes lenders swing them wide open and compete with each other to usher you inside. When an underwriter sees a score this high, their entire posture changes. They see a borrower who is not just reliable, but exceptionally so. The risk of default is, in their eyes, statistically almost zero. This means you aren't just applying for a loan. You are in the driver's seat of the entire transaction. You will be offered the absolute best, rock-bottom interest rates on the market. Lenders may waive certain fees, expedite your paperwork, and require less documentation because your score has already done all the talking. You have maximum leverage. It's the financial equivalent of being a VIP. You get the best table, the best service, and the best price simply because of who you are, or rather what your number says you are. Now, right below the elite is a tier that is, for all practical purposes, just as powerful. This is the excellent tier, typically ranging from 740 to 799. And inside this tier lies one of the most important magic numbers in all of consumer finance: 740. For decades, a 740 FICO score has been the unofficial threshold for qualifying for the best conventional mortgage rates. While an 820 might get you some extra bragging rights in the eyes of the mortgage pricing engine, a 740 often gets you the exact same elite-level interest rate. Crossing over from 739 to 740 can be the single most profitable point you can gain on your credit score. It can literally save you tens of thousands of dollars over the life of your loan. Imagine two identical applicants buying identical houses. One has a 739 score. The other has a 741. The applicant with the 741 score might get an interest rate that's an eighth or even 0.25% lower. That seems tiny, right? But on a $400,000 30-year mortgage, a quarter-point difference can mean paying over $20,000 more in interest. For 2 little points. This is why we obsess over this stuff. For lenders, a 740-plus score still represents a prime, low-risk borrower. The approval process is smooth, and you'll have your pick of loan products and lenders. The next level down is the good tier, from about 670 to 739. This is where the majority of American homebuyers live. If your score is in this range, take a breath. You are going to get a mortgage. You are considered a solid, creditworthy applicant. However, this is where the game changes slightly. You're no longer a VIP that lenders are fighting over. You're a valued customer, but you'll be playing by their rules. The interest rates offered will be very good, but not the absolute best. They'll be a step above what the 740-plus crowd gets. More importantly, this is where private mortgage insurance, or PMI, starts to become a bigger and more expensive factor. If you're putting down less than 20%, your PMI premium is directly tied to your credit score. A borrower with a 680 score will pay a significantly higher monthly PMI payment than a borrower with a 730 score, even for the same loan amount. So while you'll get approved, your total monthly housing costs will be noticeably higher than it would be if you were just a few dozen points higher. It's the difference between a good deal and a great one. Now we enter the gray area. The fair tier, which typically spans from $580 to $669. Getting a mortgage in this range is absolutely possible, but it is a completely different ballgame. The difficulty level just ramped up significantly. When a lender sees a score in the mid-600s, their mindset shifts from, how can we win this customer's business? To, how can we mitigate our risk? Your application will face intense scrutiny. Every line item on your bank statement, every source of income, every past debt will be put under a microscope. The interest rates offered will be substantially higher. We're not talking about a quarter of a point anymore. It could be a full percentage point or more, which translates into hundreds of dollars extra on your monthly payment. Your PMI will be very expensive. Your debt-to-income ratio requirements will be stricter. In this tier, lenders start looking for what they call compensating factors. A low credit score is a major negative, so they need major positives to balance it out. Do you have a very large down payment? Have you been at the same job for 10 years? Do you have significant cash reserves in the bank after closing? These factors can help push a borderline application over the finish line. This is also the territory where government-backed loans, like an FHA loan, become a crucial lifeline. The FHA will insure loans for borrowers with scores as low as 580, or even 500 with a larger down payment. This gives lenders the security they need to approve your loan, but this lifeline comes at a cost. FHA loans require you to pay a hefty upfront mortgage insurance premium and a monthly mortgage insurance premium for the entire life of the loan in most cases. It's a powerful tool to get you into a home, but it's a financially draining one. Finally, we arrive at the last tier, which we'll call the rebuilding phase. This is for scores below 580, and here we have to be brutally honest. Securing a mortgage from almost any traditional lender with a sub-580 score is nearly impossible. It's not personal. It's purely a risk calculation. From a lender's perspective, a score this low indicates a history of significant financial distress, multiple late payments, collections, defaults, or even bankruptcy. The statistical probability of another default is simply too high for them to take the risk. If your score is in this range, seeing a mortgage pre-approval denial isn't a failure. It's a signal. It's the market telling you that before you take on the enormous responsibility of a mortgage, there is foundational work to be done. The focus must shift from home shopping to aggressive credit repair. This means tackling collections, using tools like secured credit cards to build a positive payment history, and creating a track record of financial stability over time. It's not a permanent ban from homeownership. It is a required detour to rebuild your financial foundation so that when you do apply again, you're not just squeaking by in the fair tier, but striding confidently into the good, or even the excellent tiers. Because every single point you gain isn't just a point. It's leverage, it's power, and most importantly, it's thousands of dollars back in your pocket. Your score dictates the price you pay for the American dream. But your credit score is only one half of the core equation. Even a perfect 850 can't save your application if the other critical number, your debt-to-income ratio, is dangerously out of balance. It's called your debt-to-income ratio, or DTI, and it's the single most brutal, unforgiving number in the entire mortgage process. If your credit score is a story of your past reliability, your DTI is a snapshot of your present-day reality. It's the raw mathematical truth of your financial life, showing a lender exactly how much of your income is already spoken for, before you even have a chance to spend it. It answers the fundamental question. Not will you pay, but can you pay? Think of it like this. Imagine your monthly income is a glass of water. Every debt you have, your car payment, your student loans, your credit card bills, is someone taking a sip from that glass. The lender wants to pour a big new mortgage payment into that glass, but first they need to see how much water is actually left. If the glass is already half empty, they get nervous. If it's almost empty, they walk away. Your DTI is the measure of how full or how empty that glass truly is. The formula itself is deceptively simple. Your total monthly debt payments divided by your gross monthly income. But the devil is in the details of what counts as debt and what counts as income. Let's start with the debt side. Lenders are looking at all your fixed, recurring monthly obligations that appear on your credit report. This includes your car loan, student loans, personal loans, and the minimum monthly payments on all your credit cards. Even if you pay the balance in full each month, they still use that minimum payment in the calculation. It also includes court-ordered payments like alimony or child support. What it does not include are your everyday living expenses. Your grocery bill, your gas, your utilities, your cell phone bill. Lenders assume you'll manage those out of whatever income is left over. This is a critical distinction. They are only concerned with the contractual debts you are legally obligated to pay each month. Now for the income side. And this is a big one. They use your gross monthly income. That's your salary before a single dollar is taken out for taxes, health insurance, or your 401k. For salaried employees, this is easy to calculate. But for hourly workers or those who rely on commissions, bonuses, or are self-employed, it gets more complex. Lenders will typically need to see a 2-year history and will average that income to get a stable, predictable monthly figure. They need proof that your income isn't a temporary fluke, but a reliable stream they can count on for the next 30 years. With these two numbers, lenders calculate not one, but two different DTI ratios. The first is the front-end ratio. This is simple. It's just your proposed new monthly housing payment, that's principal, interest, taxes, and insurance, often called PITI, divided by your gross monthly income. It essentially asks, can this person afford this specific house payment in a vacuum? But the one that really matters, the one that makes or breaks most applications, is the back-end ratio. This is the big one. It takes your new proposed housing payment, adds it to all your other existing monthly debts, and then divides that total by your gross monthly income. This is the number that shows the complete picture. It answers the real question. Can this person afford this house on top of their entire existing financial life? Let's put this into action. Meet Sarah. Sarah earns $7,000 a month before taxes. She has a $450 car payment, a $300 student loan payment, and $150 in minimum credit card payments. Her total existing debt is $900 a month. She wants to buy a home with a total monthly PITI payment of $2,300. Her front-end DTI would be that $2,300 housing payment divided by her $7,000 income, which is 32.8%. That looks great, but her back-end DTI is where the real test happens. We take the $2,300 house payment plus her $900 in other debts, for a total of $3,200. We divide that by her $7,000 income. Her back-end DTI is 45.7%. And that number, 45.7, puts her application right on the edge of a cliff. You see, lenders live and die by DTI thresholds. While it varies slightly by loan type, the magic numbers are generally understood across the industry. A DTI below 36% is the gold standard. You're seen as a very safe bet. You have plenty of cash flow, and you'll likely sail through underwriting. The most common cutoff for a conventional loan is 43%. If you're at 43% or below, you're generally in the clear, assuming your credit and assets are also in good shape. Once you cross that line and head towards 50%, you enter a gray area. Some government-backed loans, like an FHA loan, might go this high, but only if you have what are called compensating factors. This means you need something else in your profile to be exceptionally strong, like a massive down payment, a huge amount of cash reserves left after closing, or a near-perfect credit score. You're asking the lender to take a bigger risk, so you have to give them a compelling reason to do so. Anything over 50% is, for the vast majority of lenders, an automatic denial. A no. The computer says no, the underwriter says no. It's a dead end, because at that point, more than half of your pre-tax income is being consumed by debt payments. There is simply not enough left over to handle the unpredictability of life. A job loss, a medical emergency, a major home repair. You're not just house poor. You're a statistical time bomb. This is why a perfect credit score can be rendered completely useless. Let's compare two applicants. First, we have high credit Chris. Chris has an 820 credit score. He's never missed a payment in his life. He makes a great salary of $10,000 a month. But Chris also has a $1,200 payment on a luxury SUV, $800 in student loans from grad school, and another $400 in minimum payments on various store and credit cards. His total existing debt is $2,400. He applies for a mortgage with a $3,000 PITI. His total proposed monthly debt would be $5,400. His DTI? A staggering 54%. Despite his flawless credit history, Chris is denied. His score shows he's willing to pay, but his DTI shows he is simply not able to take on more debt. His financial glass is already too empty. Now meet average credit Amy. Amy's credit score is a 680. It's good but not stellar. She had a late payment a couple of years ago. She makes a more modest $6,000 a month. But Amy drives a paid-off car. Her only debt is a $200 a month student loan. She applies for a more modest home with a $2,000 pity. Her total proposed debt is just $2,200. We divide that by her $6,000 income, and her DTI is a healthy 36.6%. Amy gets approved. She'll pay a slightly higher interest rate than Chris would have because of her lower credit score, but she gets the keys to her new home. Why? Because her application tells a story of manageable risk. She has proven she can live within her means and has plenty of income left over each month to handle the new payment. This obsession with DTI is a direct scar left by the 2008 financial crisis. In the years leading up to the crash, lending standards became dangerously loose. Lenders gave out no-doc loans where you didn't have to prove your income at all. The DTI ratio was often ignored. The result was a catastrophe built on a mountain of unsustainable debt. Millions of Americans were given mortgages they could never realistically afford to repay. When the economy turned, it all came crashing down. The strict DTI rules we have today were born from that fire. They exist to protect the entire financial system, but they also exist to protect you, the borrower, from being put in a home you can't afford. So you've seen how a high DTI can slam the door on your mortgage dream, even with a perfect credit score. The question now is, how do you fight back? How do you surgically lower that number and transform your application from a maybe to a definitely? Because lowering your DTI isn't just about paying off debt. It's about strategically re-engineering your entire financial profile, and sometimes it involves moves you would never ever expect. One of the most common pieces of financial advice is to pay off your highest interest debt first. It's called the avalanche method, and mathematically, it saves you the most money over time. But when you're applying for a mortgage, that advice can be spectacularly, catastrophically wrong. The lender's DTI calculation doesn't care about your interest rates. It cares about one thing and one thing only: your minimum monthly payments. This is the first unexpected move. You don't attack the debt with the highest interest rate. You attack the debt with the highest monthly payment relative to its outstanding balance. Let's imagine a car loan. You owe $5,000, but the monthly payment is a whopping $500. Now let's imagine a student loan. You owe $30,000, but the monthly payment is only $300. Conventional wisdom says to ignore the car loan because its interest rate is probably lower and chip away at the massive student loan. But for a mortgage underwriter, paying off that $5,000 car loan instantly frees up $500 of monthly cash flow. It vaporizes that payment from your DTI calculation. Paying $5,000 towards the student loan? It might not change your minimum monthly payment one single penny. Your DTI would remain exactly the same. So, for the price of $5,000, you could either lower your DTI significantly or not at all. Which move do you think the lender wants to see? You have to start thinking like an underwriter. They aren't your financial planner. They are risk assessors. They are looking at a snapshot in time, your application, and that $500 car payment is a giant red flag, regardless of the interest rate or the small balance. It's about surgically removing the most damaging payments from your report, not the most expensive ones. But what if you don't have a chunk of cash sitting around to just pay off a loan? This is where we move from simple tactics to grand strategy. This is about playing offense, not just defense. Most people obsess over the D in DTI, the debt. They forget that the equation has another, equally powerful variable: the I, the income. Increasing your documented, qualifiable income has the exact same impact on your ratio as decreasing your debt. And this is where so many people leave money on the table. Let's talk about side hustles. In today's economy, millions of Americans have a side gig. From driving for Uber to freelance writing to selling crafts on Etsy. They see that extra income hitting their bank account and they assume a lender will see it too. But that's not how it works. For a lender to consider income from self-employment or a side hustle, they almost universally require a 2-year history. 2 full years of tax returns showing that income. Not 20 months. Not 23 months. 24 months. If you're at month 22 and you're rushing to apply for a mortgage, you might be making a monumental mistake. Waiting just 2 more months could suddenly add $50, $60, or $70,000 of qualifiable income to your application, completely transforming your DTI ratio and your purchasing power. This isn't just about making more money. It's about having the patience and the foresight to properly season that income so it counts. The same principle applies to bonuses and commissions. You might have had a killer year and received a massive bonus. You're ready to run to the bank, show them the pay stub and get that pre-approval. But the lender will look at you and ask for your last 2 years of bonus and commission history. They will then average it. That one incredible bonus will be averaged with the smaller one you got the year before. So, if you got a $50,000 bonus this year but only a $10,000 bonus last year, the lender doesn't see $50,000. They see the average, $30,000. That's an extra $2,500 a month in income, which is great, but it's not the $4,000 plus you were counting on. Understanding this 2-year averaging rule is critical. It allows you to time your application to maximize your strengths. If you know a big commission check is coming but last year was slow, you might strategize with your loan officer about the best time to apply to present the most stable and flattering income picture. Now let's combine these ideas into a truly next-level strategy, something most people would never consider. Let's go back to that $500 car payment. You don't have $5,000 in cash to pay it off, but maybe you have a 401k. Most people would scream, "Never touch your 401k," and in most cases they're right. But we're not playing for most cases. We're playing to win the house. Many 401k plans allow you to take a loan against your own savings. You're essentially borrowing from yourself and paying yourself back with interest. The beauty of this, from a mortgage perspective, is that a 401k loan payment is typically not counted in your DTI calculation. Why? Because it's a loan against your own asset. You're not paying an external creditor. So the strategic move could be this. You take a $5,000 loan from your 401k. You use that money to immediately pay off the car. Your $500 car payment vanishes from your DTI. It's replaced by a 401k loan payment of, say, $100 a month, which the lender ignores. You have just spent $0 out of pocket and permanently lowered your DTI calculated monthly obligations by $500. It's a financial chess move. Is it risky? Of course. You're messing with your retirement, and if you leave your job, that loan might become due immediately. It's not a move to be taken lightly, but it is a powerful example of how re-engineering your financial profile, not just improving it, can be the key that unlocks the door to homeownership. It's about understanding the specific, and sometimes peculiar, rules of the mortgage game and using them to your advantage. And it doesn't stop there. Think about income you might not even realize you have. Are you about to get a promotion and a raise? Don't apply for the mortgage a week before the raise hits. Wait until you have the offer letter in hand. A documented, future-dated raise can often be used to qualify. The underwriter can see clear evidence that your income is increasing to a specific amount on a specific date. That piece of paper can be worth tens of thousands of dollars in borrowing power. Or consider this. What if you plan to rent out a room in the house you're buying? Or what if you're buying a duplex and plan to live in one unit and rent the other? You might be able to use that potential rental income to help you qualify for the loan. Lenders have specific rules for this. They'll usually require a signed lease agreement and a security deposit from a tenant, or they'll order a special appraisal that includes a rent schedule, which estimates the fair market rent for the property. They won't give you credit for 100% of the rent, usually it's 75%, to account for potential vacancies and maintenance, but even that can be a game changer. It's income that doesn't exist yet, but it's real, it's documentable, and it can be used to dramatically lower your effective DTI. This is the level of detail that separates a denied application from a clear to close. It's about moving beyond the basics of pay your bills on time and into the realm of strategic financial architecture. You are the architect of your application. Every debt, every income source, every asset is a building block. And simply having good blocks isn't enough. You have to know how to assemble them in the precise way the underwriter is trained to view them. By focusing on high-impact payments, documenting every penny of your seasoned income, and creatively leveraging every tool at your disposal, you can take a borderline file and make it a slam dunk. They finally got their DTI in line, the ratios looked perfect, the income was documented. They breathed a sigh of relief, thinking the hard part was over. But then the underwriter sent an email with a question that made their blood run cold. A question not about how much money they had, but where exactly it came from. And that's when they realized that getting approved isn't just about numbers. It's about telling a story with your money, and every single deposit is a chapter the lender is going to read. This is where so many perfectly qualified people get tripped up. They have the credit score, they have the income, but they have a messy financial story. Think about it from the lender's perspective. An unexplained $5,000 cash deposit a month before you apply for a mortgage? To you, that's your uncle repaying an old loan. To the underwriter, that could be an undisclosed loan from a loan shark, an illegal side hustle, or money laundering. They have no idea. And because of strict federal regulations like the Patriot Act, they can't just take your word for it. They are legally required to source every significant, non-payroll deposit. If they can't, they have to disregard that money entirely. In a worst-case scenario, it can trigger a full-blown fraud alert that kills your application on the spot. Your bank statements aren't just proof of funds. They're a character reference for your financial life. So, your credit score is the headline, your bank statements are the first chapter, but what about the rest of the book? The next major character in your financial story is your debt-to-income ratio, or DTI. This is, without a doubt, the number 2 reason applications get denied right after credit issues. DTI is deceptively simple. It's a percentage that shows how much of your gross monthly income goes towards paying your monthly debts. Lenders look at 2 types. The front-end ratio, which is just your proposed new housing payment, principal, interest, taxes, and insurance, divided by your gross income. But the one they really care about is the back-end ratio. This is your total debt, the new mortgage payment plus all your other monthly obligations like car payments, student loans, credit card minimum payments, and personal loans, divided by your gross monthly income. Let's make this real. Imagine you and your partner make a combined gross income of $10,000 a month. A great income. Your proposed new mortgage payment, with taxes and insurance, is $3,000. That's a 30% front-end DTI. Looks good. But you also have 2 car payments totaling $900, student loans at $500 a month, and about $100 in credit card minimums. You add that all up. $3,000 for the house, plus $1,500 for the other debts. That's $4,500 in total monthly debt. Now you divide that by your $10,000 gross income. Your back-end DTI is 45%. For most conventional loans, the absolute maximum DTI is often capped at 43%, though some programs might stretch to 45% or even 50% for exceptionally strong applicants, meaning people with massive cash reserves and near-perfect credit scores. But for the average person, crossing that 43% threshold is like hitting a brick wall. This is a critical concept to grasp. You can have an 800 credit score and $100,000 in the bank, but if your DTI is 52%, you will be denied. Your income doesn't matter as much as the proportion of your income that's already spoken for. It's not about how much you make, it's about how much you have left over. A high DTI tells a lender that you're financially overextended, that one small emergency, a job loss, a medical bill, could push you over the edge and into foreclosure. You become too risky no matter how great your credit history is. The single best thing you can do before applying for a mortgage, besides working on your credit, is to calculate your DTI and attack it. Pay off a small loan, get rid of a car payment if you can. Every $100 you can shave off your monthly debt obligations dramatically increases your borrowing power and your chances of approval. The third pillar of your application is your employment history and income stability. A lender isn't just loaning you money today. They're making a 30-year bet on your ability to earn money in the future. They want to see a stable, predictable track record. The gold standard here is 2 years. 2 years of W-2s from the same employer is a lender's dream. It shows consistency and reliability. If you've switched jobs recently, that's not a deal breaker, as long as it was in the same industry and ideally for a higher salary. That shows career progression. But if you were an accountant for 5 years and just quit to become a freelance artist 2 months ago, that's a giant red flag. Your income stream just went from predictable to highly speculative, and lenders hate speculation. This is especially crucial for anyone who is self-employed, a freelancer, or part of the gig economy. You don't get a W-2. So how do you prove your income? The answer is taxes. You will need to provide your last 2 years of complete, filed federal tax returns, including all schedules. They will typically average the net income from those 2 years to determine your qualifying monthly income. This is a huge pitfall. Many self-employed people are brilliant at using write-offs and deductions to lower their taxable income. That's great on April 15th, but it's a disaster when you're applying for a mortgage. If you earned $100,000 but wrote off $70,000 in expenses, your qualifying income isn't $100,000. It's $30,000, and you'll only be able to qualify for a loan based on that much lower number. If you're self-employed, you have to plan years in advance, strategically deciding how much income to declare versus how much to write off, long before you ever talk to a loan officer. Finally, we have the asset side of the equation, your down payment and reserves. This is measured by something called the loan-to-value ratio, or LTV. If you're buying a $500,000 house and you put down $50,000, you're borrowing $450,000. Your LTV is 90%. If you put down $100,000, your LTV is 80%. To a lender, this is all about your skin in the game. The more of your own money you have invested in the property, the less likely you are to walk away and default if times get tough. A lower LTV makes you a significantly less risky borrower. This is also where that dreaded acronym PMI comes into play. Private mortgage insurance. If your LTV is higher than 80%, meaning you put down less than 20%, the lender will almost always require you to pay PMI. This is an extra insurance policy that protects the lender, not you, in case you default. It can add hundreds of dollars to your monthly payment without a single cent going towards your principal. A higher credit score can get you a slightly better PMI rate, but the only way to avoid it entirely on a conventional loan is to have a 20% down payment and an 80% LTV. Lenders also want to see that you have cash reserves left over after you pay your down payment and closing costs. They want to know you won't be house poor on day one. Having 2 to 6 months worth of your proposed mortgage payment sitting in the bank after closing gives them immense peace of mind. It's your safety net, and it's a massive checkmark in your favor on the application. So you see, your credit score is the key that gets you in the door. It's the first thing they look at, and it sets the stage for everything else. But it's not the whole show. Your application is a four-legged stool: credit score, debt to income, employment stability, and assets. If any one of those legs is too weak, the whole thing can topple over. You need to prepare every single piece of this financial puzzle. You have to clean up your credit, pay down your debt, document your income, and source your savings. You have to build a file so clean, so organized, and so compelling that the underwriter has no choice but to stamp it approved. You've done the work, you've built the perfect application package, and you finally submit it. And then you wait, because your file is now entering the most critical and least understood phase of the entire process: underwriting. This is the final boss battle. The black box where a single person holds the fate of your homeownership dream in their hands. And it's where a shocking number of deals quietly fall apart in the final hour. The underwriter is the final human checkpoint between you and the keys to your new home. They are a trained, professional risk analyst employed by the lender, and their one and only job is to protect the bank's money. They don't know you. They don't care about the color you want to paint the living room, or the school district you're so excited about. They see you as a file, a collection of numbers and documents. Their task is to meticulously verify every single piece of information you and your loan officer have submitted, and to make a final binding decision. Is this loan a safe bet or a potential default? They will re-pull your credit. They will re-verify your employment, sometimes calling your HR department the day before closing. They will scrutinize your bank statements line by line, looking for anything that seems out of place. That pre-approval you were so proud of? To the underwriter, it's just a preliminary sketch. They are painting the final, detailed masterpiece, and they will question every brushstroke. This is where your credit score's role transforms. It's no longer just a gatekeeper number. The underwriter dives deep into the story behind the score. A 760 score is fantastic, but the underwriter will look at the report and ask, why? Is it because you have a 15-year history of on-time payments across multiple accounts? Or is it because you just became an authorized user on your parents' pristine credit card last month, artificially inflating your score? They can tell the difference. They'll see a recent car loan and recalculate your debt-to-income ratio on the spot. They'll see a flurry of recent credit inquiries and demand to know if you've opened new, undisclosed accounts. This is the most critical period of financial lockdown in your entire life. From the moment you are in underwriting until the moment you have the keys in your hand, you must think of yourself as being in a financial coma. You do not make any sudden moves. I'm going to give you a list of cardinal sins, things you absolutely, under no circumstances, should do while your loan is in underwriting. First, do not buy a car. I don't care if it's the deal of a lifetime. Financing a vehicle adds a significant monthly payment and a hard inquiry, completely torpedoing the debt-to-income ratio the underwriter just approved. Even paying cash for it can be a problem, as it creates a large, questionable withdrawal from the assets you were supposed to have for closing. Second, do not finance anything else. No new furniture for the house. No new laptop on a Best Buy card. No new anything. Every time you open a new line of credit, It hits your report and sends a massive red flag to the underwriter that your financial situation is unstable and has changed since you applied. Third, do not change jobs. I know life happens, but if you can possibly avoid it, stay put. A job change, even for a higher salary, introduces a variable. The underwriter has verified your income and employment history with your current employer. A new job means they have to start that process all over again, and many lenders have a policy against lending to someone who hasn't been at their new job for a certain period, often 30 to 90 days. Can kill the deal instantly. Fourth, do not make large, unsourceable cash deposits into your bank account. If your grandma gives you $5,000 in cash for a housewarming gift, that's wonderful, but it's a nightmare for an underwriter. They need to source every penny you're using for the down payment and closing costs to ensure it's not a secret, undisclosed loan from someone else, which would violate federal anti-money laundering laws. Any large deposit needs a paper trail, a gift letter, a bill of sale if you sold something. Cash from under the mattress is the kiss of death. And fifth, do not co-sign a loan for anyone. Not for your brother's apartment, not for your cousin's car. When you co-sign, you are 100% legally responsible for that debt in the eyes of the lender. That debt immediately goes onto your credit report and is factored into your DTI, which can disqualify you overnight. During this phase, you'll likely get what's called a conditional approval. This is a good sign. It means the underwriter has reviewed your file and is willing to approve the loan if you can satisfy a list of conditions. This list can feel daunting. They might ask for a letter of explanation for a late payment from 3 years ago. They might ask for your full divorce decree to verify alimony payments. They might ask for the last 2 years of tax returns for a side business you barely remember you had. Don't panic. This is normal. Your job is to work with your loan officer to provide every single document they ask for as quickly and completely as possible. And then one day you'll get the call or the email. It will contain 3 of the most beautiful words in the English language. Clear to close. This means the underwriter has signed off. The file is complete. The bank is ready to wire the money. The intense scrutiny is over. You've passed the final exam. All the work you did, saving your down payment, boosting your credit score, gathering documents, resisting the urge to buy a new sofa, it has all paid off. Let's zoom out for a second and look at the entire journey. We started with the very DNA of your financial reputation, the FICO score. We broke down its 5 components: payment history, amounts owed, length of history, new credit and credit mix, and showed how each one tells a piece of your story. We saw how this single 3-digit number acts as the master key, determining which mortgage products you can even apply for, from FHA to conventional to VA loans. We walked through the pre-approval process, where that score gave you a budget and the power to make a serious offer on a home. We dove deep into the weeds of debt-to-income ratios, revealing how your credit score is only half the equation. Your ability to manage your existing debt is the other. We saw how lenders use that score to set your interest rate, a decision that can save or cost you tens, even hundreds of thousands of dollars over the life of your loan. And finally, we've just navigated the treacherous waters of underwriting, where that credit report was placed under a microscope, and your every financial move was scrutinized until the final clear to close. The thread that connects every single step of this process, from dreaming about a home to holding the keys, is your credit. It's not just a number. It's the quantifiable measure of your financial reliability. It is the story you tell lenders about your past, which they use to predict your future. But the story doesn't end when you sign the closing documents. In fact, a new chapter begins. That same credit score will influence your life as a homeowner in profound ways. A few years down the road, if interest rates drop, a high credit score will allow you to refinance your mortgage, potentially lowering your monthly payment by hundreds of dollars. If you need to make a major repair like a new roof, a strong credit score gives you access to a home equity line of credit, or HELOC, at a favorable rate. It can even impact your homeowner's insurance premiums, as many insurers use a credit-based insurance score to help determine your rates. The discipline you learned and applied to get your score mortgage ready is the exact same discipline that will build wealth for you and your family for decades to come. It's the habit of paying bills on time every time. It's the wisdom of keeping debt low and manageable. It's the patience of building a long, positive history. The American mortgage system can feel complex, intimidating, and at times deeply unfair. It's a maze of rules and requirements designed to protect the lender. But it is not an impossible maze. It's a game with a clear rulebook. And by understanding that rulebook, by understanding how your credit score is calculated, how it's perceived, and how it's applied at every stage, you give yourself the power to win. You are no longer just a passive applicant hoping for the best. You are an active, informed participant who can strategically shape your financial narrative to achieve your goals. The journey to homeownership is a marathon, not a sprint. But it begins with a single step: taking control of your credit. Your financial story is yours to write. Start writing a great one today.